So here we go, HIMS and HERS earnings. Let's take a look at it, and of course we'll get on to this point, the share price, in a little bit. Towards the end of the video we'll talk about that share price, because that share price movement today was ridiculous. It's been a while since I've seen a share price movement like that, and that's what I think a lot of you guys will be looking for and see my thoughts on that share price movement. But HIMS and HERS, we always talk about their earnings. I think, we always do a breakdown of DraftKings earnings on the channel. We talk about HIMS and HERS and do a full breakdown of their HIMS and HERS earnings on the channel. And obviously today I've got a couple of notes to share with you guys and my thoughts on the earnings. And as always, it was a good smash. HIMS and HERS did a really good smash or beating their earnings. And I think overall, I'm a little bit guilty of doing this, and I think a few people have been a little bit guilty of this, because obviously when we get onto this in a few seconds, or a few minutes should I say, I think if we're looking for why is it dropping that? Why has that happened? Why is this happened? You're trying to pick out the little details about why that might have happened. But realistically, I thought, let's just step back a little bit and let's look at the whole picture. And once again, when you look at the whole picture here, these earnings are fabulous. Like, this company that's growing at these rates with these gross margins and growing that profitability, growing that revenue, it's scary. It's actually scary how good this company is doing that. When you step back and look at the whole picture here, it's absolutely fabulous. And then you look at the valuation, and we're going to talk about that in a second. When you look at the valuation it's trading at, it's absolutely ridiculous anyway. So let's get on to this. So EPS. I've gone GAAP EPS because that's what they were comparing to on the Seeking Alpha. But GAAP EPS came at negative 0.03. That beat by 0.01. So we had a beat on the EPS. Just wanted to point the net loss out as well. Net loss came at negative 7.2 million. So we are getting closer to a profitability point of view, although we are just at EBITDA profitability. But from a actual gap kind of point of view, we are moving a lot closer to profitability. Last year was 19.7 million, this year 7.2 million. So once again, the path to profitability is definitely starting ramping up. Point of view, I've just seen this actually mentioned on Discord not too long ago on the Patreon Discord. Someone posted about Simple Wall Street, which I would not trust their forecasts at all in the longer term. Sometimes they say that all of a sudden they now expect HIMS not to come profitable beyond, before 2025. So obviously that you got 2024, 2025. I'm just going to say here, they've gone from 19.7 million and they've improved that by 13 million. If they just do the same sort of numbers again, which actually, to be fair, because of the scale, they'll be doing, if they grow at what they're doing right now, the revenue is going to be even more. You'd expect the profitability improvements to be even more. If they just do the numbers that they have just done, they are going to hit profitability next year, and I do expect HIMS to actually hit profitability next year for sure. So just shows you, don't always trust those numbers. Full year revenue now to be expected between 830 million to 850 million. I was a little bit cheeky here. I didn't properly do the research, but I believe that was a 20 million improvement from where they were guiding previously. Like I said, I probably should have researched that on the last earnings report, but I think that's the improvement. And obviously adjusted EBITDA as well, from 35 million to 40 million. I think previously the target was, I think it was 25 million to 35 million. So obviously that's the lower guidance improved and the higher guidance improved and the midpoint improved as well. So obviously a good improvement there. So they're expecting revenue to go up and adjusted EBITDA to go up as well, which is obviously really good. Cash, probably one thing that went under the radar a little bit. Cash improved a lot. Obviously adjusted EBITDA profitability now. So they went from 46 million in cash to 65 million in cash. I gotta say, 65 million in cash is actually quite a decent cash balance. I wonder if HIMS and HERS and Andrew Dunham are looking at the share price today and going, you know what, we've got decent cash pile. We've got no debt on the balance sheet. With that cash pile, we're probably not going to burn through that much cash going forward. Are we tempted? You know what? Let's just throw a 5 million buyback out there to buy some shares up, 10 million to buy some shares up. If I were them today, I'd be really considering that. So Andrew Dunham, if you watch this video, I would consider that. Marketing. So marketing went up 47 million. I always like watching the marketing costs because they are quite heavy on the marketing side. I do the same with DraftKings. I watch the marketing a lot and see how much return they're getting for the revenue for the marketing. Marketing was up 47 million, but the revenue was up 94 million. So I'm okay with that. we have an issue where marketing goes up 47 million and then they're only generating 47 million in revenue. So the marketing going up is, I expect marketing to keep going up as the scale until HIMS and Hers comes like very well known, where they're like a national company and the costs of acquiring customers is less because they're well known. I will expect marketing for the next 3, 4, 5 years to be quite high and keep going up. But I always just like making sure that marketing isn't going up and just supporting the revenue. The revenue is going up more than marketing, and that happened once again. So I was absolutely fine with the marketing costs going up once again. 82% gross margins. Like I generally think like this goes under the radar. I think the improvement was I think they did 77% last year. Now they're up to 82%. That's absolutely crazy. 82% gross margins. You'd think that they would, with 82% gross margins, you start thinking about profitability. And obviously the long term. We're going to get onto the long term targets in a second, but when you think about profitability in the long term with 82% gross margins, I mean, you start talking, first you got like 10% profit margins. 82%, you expect probably at least 10% profit margins. But realistically, you could easily see a path where this company starts putting in 20-25% profit margins. So there's a lot of room for them to play with there further down the line. So really good gross margins once again. I think that went a little bit under the radar in this quarter. They said that mental health did, that's kind of from this statement, this onto kind of the conference call. Actually this little point here. So this was where I had a few little things where I digged into. Ops went up 12 million, tech went up 5 million, G&A went up 9 million. So there's 26 million increased costs. If it wasn't for the big jump in costs, if they could keep them lower, obviously we would have hit profitability. So if it wasn't for the increase in costs this time round, we would have been a profitable quarter. So I wanted to really dig into like the big jump in 26 million of costs for this company, because that was a little bit of a steep jump. I was expecting, obviously as you scale, you want to keep investing into the company, and I thought we might see 10-15 million improvement or extra costs. I didn't expect 26 million, a bit heavy, but as this is a conference call, sounds like they're being investing quite heavy into the company. Looks like they're being preparing for a couple of new category launches, so I can see why they're scaling up for the cost point of view. So I was okay after listening to the conference call, but I was a little bit like, if we can make sure we control them costs, because I think they can hit profitability very, very soon if they keep these costs down. So I was fine with that. I didn't note that down as quite a big increase, but I was okay after listening to the conference call, so I thought I'd let you know on that. Mental health, mid triple digits. They said that this was the word in the conference call, is that we basically have confidence that we'll meet the 2025 long-term targets, and also that we will surpass the 2025 targets. Now, it doesn't take a genius to realise that the long-term targets that HIMS and Hers has set out, which I believe is like 1.2 billion in revenue in 2025, and also 20% adjusted EBITDA targets, I think, in 2025, they are going to beat them. They are going to beat them numbers 100%. So that was basically the management team saying we are going to beat them, and I would expect probably in the next kind of 2 quarters, I would maybe towards the end of the year, is I think they'll actually update these long-term targets, or if the share price might stay low, I think maybe in the next quarter we see the update in the longer-term targets, because they're going to cross these easy. They're going to be at them long-term targets in 2024, never mind 2025. So manager was saying, look, we're going to beat the long-term targets, but I think it would be good for management team at some point to update them longer-term targets. Obviously, that was really good. They mentioned that they were working on an AI project. You got to drop AI in a conference call on earnings at the moment, haven't you? They call this Tech Med Match. Now, Med Match, not Tech Med Match. So Med Match, I was trying to get an understanding about it. I'm not sure. I put here, I don't know if this is like a kind of a good RX kind of product. I was struggling to get my head around what they were actually talking about a little bit when they were talking about a price comparison for a service. I didn't know exactly, what kind of they're pointing towards there. So they said they're going to mention it, go into a bit more detail in the next earnings. So I thought, I'll just leave it to the next earnings because they'll break it down fully there. But I was trying to understand what they're kind of doing with that kind of technology product. But obviously it looks like some sort of comparison for a service or something. So yeah, I'll wait until the next earnings before we get onto it, but probably something to worth watching out for. Weight loss management is coming. It's going to come in. So this is a new platform that they're adding into the circle of products they offer. Weight management. So that sounds a bit like they're kind of having, plans on how to get healthy or lose weight, coaching how to lose weight, maybe fitness programs, maybe a supplement kind of program that's on there. So that's obviously HIMS and Hers entering into the new category. Looks like it's going to be coming in January. They said that some other features will get added as the year goes on. So obviously really good to kind of see, HIMS and Hers pushing into more categories. That's probably also why we saw the expenses going up, because they are starting to prepare to, add more categories. And that's the key things with HIMS, is that we want it to kind of come this whole telehealth kind of platform where, you buy one service, you then buy another service, and you end up cross-selling to all your, you want to get to a point of view where you're not just having to acquire users, but your users on your platform are spending more and using more services, which obviously we saw in the recent quarter that the average volume order was up. And that's what we want to see really, is how they get more money from the customers. So obviously that's, having a complete platform is what we want to see from them. So that was great. Price changes. So I don't know if this was any kind of cause in the share price situation, which we'll get onto, but they said they've done a couple of price changes. They seem to have brought the prices down a little bit. I'm not sure if they brought the price. So they said that had a little bit of an impact, is going to have a little bit of an impact on adjusted EBITDA and revenue. They wanted to have lower prices to try and, I think, attract people into the platform. And obviously if the economies of scale, that if you can do a cheaper service, and get more clients on, then it justifies, if you get them on and then you cross-sell, then you can do that. So it looks like they're trying to do a bit of like economies of scale a little bit here, which I'm fine with, because obviously if you have, cheaper healthcare, you're probably going to get more people onto the platform, and if it doesn't affect you that much, you might as well do it. That's the benefits of having a scale. I don't know if the way that some people took that is that, are they lowering prices because they've got a kind of demand issue? That's what I was kind of thinking, is that what they're kind of looking at? And maybe they didn't like the fact that they mentioned that it will be a headwind to EBITDA and revenue. Maybe the context of how they said it was what people didn't like, but we'll get onto that in the share price in a little bit. But yeah, I thought I'd mention that, maybe something just to kind of keep an eye on. Probably the only negative that I really kind of took away from this earnings was subscribers being slower. Subscribers were a little bit slower than what they have been in this quarter or the previous quarters, but at the same time you are kind of in a bit of a summer period, so it probably is going to be a little bit slower. Also, I think the things to consider is that we've got so used to, we say it's slower and it's still like, I think it was 74%. Like, we say it's slower, but that's still absolutely ridiculous. If you go ask Teledoc, like, would you like 74% user subscriber growth? They'd be like, yeah. So, when we say it's not as good number, we've still got to take it in the context of like, it's fantastic. And also, obviously, like, when you look at the growth that they're generating and everything, it's still absolutely fantastic. And at some point, these numbers that we've seen HIMS and Hers do, where it's like 80-90% growth, they can't do that forever. There's a point where the numbers have to start slowing down. 80, 70, 60, 50, 40%. It's still ridiculous amounts of growth. So even though I'm saying that was a little bit weaker and is a number to keep an eye on, it was still absolutely ridiculous. And the fact that we're saying we should be a little bit watching 74% growth, I don't know really. So, the main thing is that, when you look at that, in the context of the whole thing, like you're trying to pick on that maybe a small thing, but, you got an EPS beat, you got losses are coming down rapidly, revenue is hiked up, EBITDA's hiked up through it's a triple beat, like in the context of the long-term picture, like I'm being really picky here, what I'm trying to say. So yeah, obviously, like when I look at the longer-term targets, like 2024, I think that obviously longer-term targets is, when I was looking at analysts are now expecting 24% revenue growth in 2024. Like, no way HIMS going to do 24% revenue growth in 2024. HIMS and Hers, like we said, they have to slow down at some point. They can't do 80-90% growth forever. But even realistically next year, they're probably going to hit 60%. If I be conservative, 50%. If I be ultra conservative, let's say they do 50% revenue growth next year, which I think is ultra conservative. it's even double what analysts are forecasting right now, which is obviously shows you the scale that they're going at, and that they're struggling to keep track how fast this company's going. Let's say they do 1 billion in revenue, which by the way, like that's I think that's the longer term target. It's either 1 billion or 1.2 billion, which they're obviously going to pass, and that's why they need to probably update the longer term guidance. But let's say they do it is 1 billion in revenue. Is long-term targets. 1 billion, I'm messing this up big time. 1 billion is the revenue target for analysts in 2024, and they're expecting that to grow at 24%. They're not going to do that. They're going to grow at least 50%. So let's say they do 1.2 billion revenue next year. Let's say they do a 10% profit margin, 82% gross margins. I think they can get to a 10% profit margin. They might not do it next year, but let's just factor in a 10% profit margin. Right now, that's going to put 120 million to the bottom line. That's currently 14 times earnings. I mean, realistically, right now, let's just say this company is, if they were able to get to that scale of profitability, which I think they can do, let's say this is 14 times earnings right now for this company, realistically, in the longer term, once those gross margins, profit margins mature. 14 times earnings for a company that's improving the bottom line this much, that's beating this much, that's done triple beat, that the EBITDAs get so far ahead of schedule, the revenue is getting hiked up that much, that's growing at 82%, 83%? It's crazy. It's crazy. Like this is a premium company. This is one of the best performing companies that's public at the moment. And if we were to have a 10% profit margin, which they probably will be able to get to, you're looking at 14 times earnings here. Like, I mean, realistically, what would you really be looking to pay? I know you get a little bit silly when you start going, it's 100 times earnings, but I mean, realistically, what should it trade at? You look at something like, let's say Tesla. What's Tesla like? 60 times, 70 times earnings. I mean, that's growing 25% a year. So this is, treble that. So, I mean, realistically, let's just say, I know it's a little bit silly to kind of put it in like a context of an absolute crazy valuation, but I mean, let's just say 60. It's quadrupled than what it is now here. It's just absolutely insane for this company that's doing these numbers. So, overall, I think this was my only negative in this quarter. And I normally give HIMS and HERS 10 out of 10, and I feel like I should do that again because these numbers are ridiculous. Let's just say, for the sake of argument's sake, let's just say that was a little bit lower than what we would want. Let's say it's a 9.5 out of 10 quarter. It's still fantastic. You look at these numbers. When you've beaten EPS, when you've beaten revenue, when you've hiked your guidance up, you've got a triple beat. And these numbers are fantastic. The company is better than where it was 24 hours ago. Before this company reported these earnings, the company is better than where it was 24 hours ago. If your losses are down, your revenue is up, and you've hiked your outlook for the next year up, your company should be valued more. So I mean, I look at the share price today. Should the share price be down? It shouldn't be down. Like, these numbers justify the company to be valued more today than where it was 24 hours ago. The share price should be up today. It should be up a lot more today. Obviously, the stock market is a crazy thing. Share prices can do stupid things. We've seen that multiple times. We've seen it so much in the last 12 months. My reaction is that I don't know if it's off earnings, because I look at it, the earnings came out, they did the conference call, and even to the point where the market opened for us UK time 2:30, the shares were still up like 15%. So the market didn't digest the numbers. Like, they didn't look at the earnings. They were fine with the earnings. Look at the conference call. They're fine with the conference call. And then the market opened and then it sold off, which makes me think that the market didn't see anything it didn't like in the earnings call or in the conference call or the earnings. That makes me think it's just the market. It's the market. We had a pretty bad day today. Sell-off hits HIMS and HERS. Maybe profit taking. Maybe like algorithm bots, maybe there's some short interest playing on it and there's some short sellers trying to move the stock. I don't know. What makes me look at this, it's just one of those day-to-day reactions where you go, it don't make sense. And it happens, 12 months ago we were talking about this stock at $3. It didn't make sense. This company was doing these amazing numbers and fantastic numbers, when it was $3, and you're looking at them bringing out earnings and it was at $3, and it was like, it doesn't make sense why this is at $3. So unfortunately, it happens in the stock market. There's times where you just go, it doesn't make sense. but it happens in the stock market, and that's the crazy things with stock market. Like, you look at, like, you know, house properties. House properties can move a little bit in value, whereas the stock market can generally put things to prices that don't make sense. But that's where you can get amazing opportunities in the market, because the market sometimes does things that just doesn't make sense, and then realistically, then it goes up, and then you go, oh, why did that get to that sort of levels? You know, you say the same thing with DraftKings. It got to $10, and you're like, it doesn't make sense. You know, doing as good numbers as it is today, it doesn't make sense. And then realistically, the market rallies up. You know, Card Factory, we talked about Card Factory yesterday. Like, you know, even though the company was paying off the ugly debt on its balance sheet, the profit was up, the revenue was up, it then put it down to CV lows. And it didn't make sense, because the stores are open, the CV threat's gone, the profit's up, the revenue's up, the balance sheet's so much better than where it was. But then you put it back, you know, back down there on the share price point of view. You know, something like a Meta. You know, Meta, you go, oh yeah, it's got issues, but then, you know, it goes down to $88, and then all of a sudden at $88, everyone goes, actually, this company's actually one of the best market companies on the stock market. And then from $88, it runs up to like $300. It just happens. Like, the stock market does crazy things, and the stock market is totally different from anything else out there. You know, the values of things can change because of or can get valued for crazy reasons for no reason, because what one person can value it at can be totally different to what someone else can value it at. And all of a sudden, if that sentiment has taken over, then it just goes to, you know, a stupid level. So I just think it's one of those. It shouldn't have happened, but it has happened. And if anything, I just look at that and go, you know what? If the market wants to be a little bit silly and put HIMS down to $7, $6, $5 would be really good. You know, if it goes down to some sort of levels, I'm going to buy that, because realistically, I look at the numbers, I look at where the company's going, I look at the long term, where the long term of the business is going to go. I look at what I think they'll do and what it should be valued at. I think it'll get there, and I look at that going, you know what? If you want to be a bit silly and put the stock down to $6 or $5, give me it, because I'll buy it. I'll buy it, because I think that in the long term this will get a lot more correctly valued, and I don't know why there's suddenly a sentiment switch with that. Like I said, I don't know if it's just because we were in a bit more of a negative sentiment and a negative day sentiment, but you know, it's one of those where, you know, I see it as an opportunity. I see it as an opportunity where, just as good as an opportunity where the stock was $3 12 months ago, and then there's all this progress made, and it goes up to $12, and then from $12 it goes back down to $7 or $6 or $5. I just look at that as another amazing opportunity where I can buy some shares, and that's what I look at it as. So yeah, I mean, overall I thought it was a really, really good quarter again. Like I said, if I'm being really picky, I think that one number was the only concern in the quarter, but that's me being really picky to try and justify a reason why it swung down so much, because it shouldn't have done. You know, I look at these numbers, triple beat, the stock, the company should be valued higher today than where it was 24 hours ago for these numbers. And for me, I look at it as an opportunity more than anything. So yeah, I hope you enjoyed the video, guys, and if you could hit that like button, and I'll see you all in a bit.